Over the past couple of days, I've been asked pretty much non-stop what my opinions are regarding when I believe the equity markets are going to be bottoming out, whether or not I think it's going to be in a couple weeks, a month, 2 months, or so forth. So today we're going to be somewhat jumping back into some stock market news, going over what's going on right now in the stock market, as well as I'm going to be sharing a couple stock picks that you might want to be looking at right now amidst this whole financial crisis, because I know that's a topic that you all really enjoy as a community. Hey, what's going on, savers and investors? As always, I hope you're having a wonderful day. If you're new to the channel, then welcome. My name's Griffin, and today's video is requested by popular demand, both from being asked what my opinions are on when the stock market is going to be bottoming out, but then also from a quick poll that I made on my community page on the YouTube channel, where I basically asked you guys what you'd like to see in the coming weeks, and quite unanimously, you all wanted to see stock market picks amongst this current financial situation. So today's video is going to be a little bit of a mix of both. I really hope you enjoy it. Now, before we do move further into the video, I do want to take a quick second here to mention the fact that if you have watched any of my previous videos, then you're most likely aware of the fact that I'm personally more of a long-term investor rather than all this short-term speculation style stuff. That's not really what I'm all about on this channel. However, just from the sheer amount and a volume of requests I've been having in the past week or so relating to when I think the stock market's going to bottom out, what are some different stock picks that I would pick right now in this current financial situation, well, I thought, you know what, I'm going to move forward and make another video sharing my thoughts about all of this and what's going on, especially for people who might be new to investing and aren't entirely sure what's going on right now and how to react in this whole situation. Also, if you're new to investing and haven't yet opened your brokerage account, then make sure to check out one of the links down below where you can open a trading account today and get some free money to start trading. So on that, smash the like button and let's get into the video. Alright, so yesterday's trading period was definitely better than what we've been seeing over the past couple of weeks or so. I mean, after all, anything in the green is better than what we've been experiencing lately and is kind of a nice refresher. The Dow closed at plus 0.95%, followed by the S&P 500 closing at plus 0.47%, and then the Nasdaq closed at plus 2.30, followed by the TSX at plus 3.83%. Even at that though, I definitely do not think we're out of the woods just yet. Today's intraday trading, for example, is trending red pretty much across the board on all markets, except the exception of the TSX, which is trending green today, surprisingly. And even on Wednesday, we hit once again the stock market circuit breaker, which is definitely an indicator that we're not out of the woods just yet. And as I've continued doing extensive research, really getting a firm grasp of where the equity markets currently stand amidst this whole financial climate, honestly, it's pretty much impossible to accurately predict and pinpoint just where the market's going to be heading over the next couple of weeks or months. And even at that, for that reason, it's much more relevant and important to compare what's going on right now to historical data and then try to apply that to what we're living through right now, and then also take into consideration some 2020 realities into this whole equation in order to try and make some reason out of what's going on instead of just predicting doomsday being around the corner. So with that said, let's take a look at a chart of the S&P 500 in order to try and make reason out of all of this and compare the drop we're experiencing right now relative to some of the other drops that we experienced in past recessions. As you can see from the chart, what we're dealing with right now is an absolute plummet in terms of stock market value relative, that is, to what we saw in previous downturns. The sheer speed that this is happening at is somewhat, in my opinion though, indicative of the times we're living in right now, but we're going to get into that shortly. This now leads me into some really interesting data related to the peak to trough timeline for past recessions, and it really showcases firsthand the sheer speed at which right now the markets are plummeting. So as you can see right here, we have two different bar graphs showcasing data related to the peak to trough timelines for the past 4 largest recessions, as well as the one we're experiencing right now. And even though this information dates from March 13th, 2020, which is last week, the information is still highly relevant to really give us an overall look at what's going on. Starting with the most severe of all, it is the Great Depression, where the Dow had tanked 89% over a period of 34 months from its pre-crisis peak. So it basically took 34 consecutive months of consecutive bear market in order to finally trickle down from the peak 89% all the way down to the trough. The next major crisis was in 1987, and this time the Dow tanked 31% over only a period of 3 months. So in terms of speed of how quickly the market tanked, this is much quicker than the Great Depression, for example. Following 1987, we have the dot-com bubble of 2000, bringing with it a market decline of 34% over a period of 43 consecutive months. So just some perspective here, in the stock market crash we're experiencing right now in 2020, which also has gone down roughly 34% across the board, this has happened in one single month, which the dot-com bubble, it took 43 months to achieve the same results from peak to trough in terms of a percentage drop in the overall markets. And finally, the Great Recession of 2008, which for most people watching this right now, considering the time you've been investing, was probably the hardest hitting, but was also the greatest opportunity for wealth creation in the stock market, regardless of what we're experiencing right now. This was a drop of 49% over a period of 16 months. Anyways, why am I mentioning all of this, and how is it relevant to what we're experiencing right now? After all, it kind of feels different than the past, or at least that's what people are trying to tell themselves because of how quickly the stock market has dropped. First of all, we're pretty much all aware at this point why everyone's freaking out and why the stock market has plunged so dramatically, all because of that one thing that we can't name here on YouTube. But as a result, full countries are pretty much going on lockdown, and this is resulting in certain businesses closing their doors temporarily and laying off people, as well as not generating as much income as they would in a normal economic climate. In my country of Canada, for example, pretty much the whole country is once again on lockdown, and people are urged to work from home if possible, and this is resulting in certain companies having to temporarily shut down their doors, and the revenues are going to be significantly less for Q1 and even potentially Q2, but we're just gonna have to wait and see the numbers when these actual earnings reports come out at the end of Q1. So from this standpoint, I personally think if we're on a total lockdown in both US and Canada for say 1 month to maybe 5 to 7 weeks, from an economic standpoint after that, it's definitely gonna hurt Q1 numbers. However, if we're able to get back out and spending after that shorter period of time, then I think we're gonna be somewhat okay from an economic standpoint, and I think after that, stock market should really start rebounding quite rapidly. However, if we're not able to properly really maintain from a medical standpoint what's going on that front, and we're on lockdown for let's say 2 months and on, then I think we're in much more economic trouble because we're not going to be able to spring back as rapidly, and Q1 as well as Q2 numbers are going to be hit really hard, which is going to reflect in the stock market. The second factors we should be considering in this whole situation is amount of negativity being spread through the media and over the internet, as well as speed of communication and access to information in the general masses. And the fact is that over the past multiple years, like probably even 5-6 years, everyone's been anticipating a stock market crash. It's on the horizon, it's gonna happen next year, and 2020 was really the year when most people were accurately predicting that there would be a stock market crash. Well, if it's not evident to most people watching, we're in the stock market crash that people have been talking about. Like, we're living it right now, it's happening all around us, and this whole health situation has just exponentially contributed to what's going on. Now, here's my opinion about what might happen in the next coming months relative to the last point I made. So if we're able from a medical standpoint really to contain that within the next month to 2 months in the future, well, I think once people are back in stores spending money, boosting the economy, and really just gaining confidence in the overall markets again and the economy, and once we have multiple news articles coming out and just having some positive market upswings, I do think that we're going to recover quicker than we did in past recessions in terms of how quickly we're going to recover, because after all, everyone now has access to phones, everyone's glued to the markets 24/7 watching news articles, and that's not to say I think it's going to go up as quickly as it's gone down, not at all. However, I do think that it might go up quicker than it has in previous recessions where it's taken 40 odd months months in order to go back up. I mean, at the end of the day, this is what an iPhone looked like in 2008, not to mention what phones looked like in 2000 and 1987. So just from a sheer speed of communication standpoint, everyone is just so much more connected and everything is just faster and faster than in previous times. So with all that said, where do I currently think the market stands and when will it bottom out? Well, obviously, if you haven't catched my drift in this video, it's pretty much impossible to say. I don't really know for that matter, and no one knows. However, what we do know is that right now, there's no usable evidence of a remedy, for example, to the whole medical situation. And as of right now, as it currently stands, North America is pretty much on a full lockdown. So it's really going to depend how quickly we're able to recover from that, get people back in stores, and essentially boost the markets again. I think once Q1 numbers come out, we're really going to have a better picture of where the market stands. And then from that point on, we'll be able to make some better predictions as to when the market's going to be recovering and gaining some momentum again. What I'm currently doing with my investments, and I've mentioned it in multiple previous videos, is I'm pretty much just dollar cost averaging on both the way down and the way up with the market. So every couple of days, I'm investing a chunk of my funds into the market, whether it's going down right now, every day it's red, I'm putting some money into the markets. But again, I was doing that also when the market was green 3 months ago, 6 months ago, a year ago. I'm a strong believer of dollar cost averaging because over the long term, this is really going to help out the gains in your portfolio and is going to smooth out returns that you're receiving. The moral of the story is this will eventually pass. There's no other way around it. It's going to pass. We're going to look back at this as one of the greatest opportunities in modern times, at least, to create crazy wealth in the stock market. So make sure you take advantage of investing in the stock market while you can at a huge discount by investing in some of the stocks that we're about to look at, as well as some of the stocks that we mentioned in previous videos. Once again, I linked down in the description some videos that we've previously covered where we've covered different stock and ETF picks. So after this video, make sure to check them out. The first stock we'll be looking at is Google, ticker GOOGL on the NASDAQ, which currently is trading for right around $1,087 only, having moved up a little bit in the last trading day, but this is down from around $1,525 in mid-February, showing as of now a 28.5% loss in share value. Definitely a steal for this company in my opinion. Google obviously is one of the largest and most influential technology companies in the world and has one of the best balance sheets for a company weathering through an economic climate such as what we're experiencing right now, with roughly $199 billion in cash as of 2019's close, which isn't as much as, say, Apple computers, but is nonetheless just a tremendous amount of cash to have on hand that can be deployed into the acquisition of more assets and companies that Google may have their eye on. Just think of, for example, YouTube, which Google had picked up for only $1.65 billion. Let's not even get into how much YouTube would be worth now, but Google's definitely a company to have on your radar and pick up in a time like right now when it's trading at such a massive discount. This leads me into my second stock to watch today, and that is a company I've mentioned before on the channel for their massive cash reserves. And honestly, how couldn't we in a situation like this? It is Berkshire Hathaway, ticker BRK.B. We're not really looking here at Class A shares because these are trading for multiple hundreds of thousands of dollars per share, but BRK.B, which is currently trading at roughly $172 a share, down 25-ish% from $230 in mid-February. If you aren't familiar with Berkshire Hathaway, well, this is a company that is led by the famous Charlie Munger and Warren Buffett, arguably the best investors of all time and very successful with their investment holding company Berkshire, which owns outright or has major stock in companies such as Dairy Queen, Fruit of the Loom, Geico, Duracell, Apple, Bank of America, and multiple more. And the reason why I'm mentioning this stock in today's video is once again due to those massive cash reserves. As mentioned with Google previously and Microsoft in my last video, Berkshire has in the whereabouts of $128 $128 billion in just cash sitting. And as we all know, Warren Buffett is a value investor and without a doubt is going to be taking advantage of these huge discounts that we're experiencing right now. So Berkshire is a stock to watch in 2020. Moving on now to the third stock to watch for today's video. This one is somewhat similar to a stock that we looked at in our last video. It is PepsiCo, ticker PEP, on the New York Stock Exchange, which currently is trading in the waters of $111 per share, down 21.5% from $147 per share in mid-February. And the reason why I'm mentioning this stock today is primarily due to their product offering and subsidiary companies, right? Pepsi has their foot in multiple different food and beverage areas, owning, for example, Frito-Lay, Gatorade, Quaker Oats, Tropicana, Brisk, and multiple more household staple brands, which I'm going to be overlaying right here on the screen. So for this reason, regardless of what we're going through economically right now, these are brands that people are buying and consuming from nonetheless, right? So in my opinion, a 20% discount on this stock, considering that this is a company that will be thriving, I have no doubt about it, in 5 to 10 years, it's a buy. And on top of everything mentioned, the price right now is translating into a nice 3.36% dividend yield on cost as of today. Next up on the roster is Starbucks, ticker SBUCKS, trading on the NASDAQ for roughly $62.30 a share only. This is down 34% since the end of January, where it was trading for right around $93 a share, so a total steal as of right now. Starbucks, in my opinion, is a company that has just unbelievable brand loyalty, as well as being a prominent brand in pretty much every single large city and airport in the world. It's one of those brands that's right up there with McDonald's in terms of brand recognition, with more than 30,000 locations worldwide, and dominates the coffee industry in North America. In past months, especially with the lockdown, most Starbucks have closed their entire seating area, or even the entire store for that matter, making it much harder for them to generate revenues, which I believe is by far one of the main factors contributing to the stock price uncertainty. But with growing revenues and bottom line, I'm a firm believer that this stock will quickly recover and continue trending green over the coming years. Following Starbucks, a stock that honestly couldn't not make today's list is the Boeing company, ticker BA, on the New York Stock Exchange. And I don't think this is really going to be any news to you, but the stock has just been hammered, trading currently under $100, down 70% from its pre-crash value of $348 in mid-February. I mean, this is just nuts, completely insane to see a company such as Boeing, which is the main plane provider other than Airbus, and obviously the whole plane and travel industries right now are in a huge crisis, but nonetheless, if you're willing to take on a little bit more risk, considering that they did just ask the US government for financial aid in the waters of $60 billion, but if you're willing to take a bit more risk, definitely keep Boeing on your radar, because once again, medically, if we're back on track in the coming months and people are more confident once again, this stock could be highly profitable for you. And right now, considering that they do keep up their dividend, which they could cut, but if they keep it up right now, we're looking at an 8.3% yield on cost. And finally, the last stock for today, which I've picked up quite a fair amount of because the current market price is just not indicative of the true value of this company, in my opinion. It is Uber Technologies Inc., ticker Uber, on the New York Stock Exchange, trading right now for a mere $21.47, down 47% from the mid-February high of around $41. And obviously, this is a stock that's taking a huge hit due to, once again, the total lockdown and people not ordering as much food with Uber Eats or actually even taking Ubers around town. But honestly, even with people on lockdown, this could be somewhat of an okay situation from a short-term standpoint because people are going to be ordering more takeout or at least trying it for the first time. Nonetheless, don't take this as me saying that this is a good time for Uber. It's definitely not. in the short term, it's bad for the company, what's going on with their whole business model. But once the company is back up and running, it's no secret that people are just loving Uber. It's the future of transportation. Taxi is totally dead. And as the company continues growing, prices are going to bounce back for sure in the long term. All right, so that pretty much wraps it up for today's video. I really hope you enjoyed the first half of the video where we went over some of my thoughts as to where the stock market's heading right now, as well as the stock market picks that we just went over. Let me know down in the comments a couple of the stock picks that are on your watch list or that you're purchasing as of right now. And if you want to learn more about investing in the stock market, make sure to check out one of the two videos right here. So on that note, smash the like button and I'll see you in the next video.